Is it really different this time or ever? We're going to read this from Legg Mason, a piece which I found very informative, and I think you'll get a lot out of this too. It's from a guy named Michael Labella, CFA, head of investment strategy at Legg Mason Company. So let's review this. I'm a big fan of this piece. I'm not familiar with Michael, but I think you'll get a lot out of this. The speed at which the coronavirus has spread to the world has been a made-for-TV moment. At the rate of contagion has accelerated, so too has the market's reaction. So we see the number of days from market peak to bear market. So in the dot-com bust, the number of days from basically bear market is 20%. You can see it took 242 days from the market peak. Now, if NASDAQ was March 5th, I think, 2000, when it passed, or March 3rd, 2000. Maybe it was March 9th, 2000, one of those days. In the first, basically, 10 days of March of 2000, when it broke 5,000. S&P 500 fell 9% in 2000, and then another 12% in 2001. So basically, it took about two-thirds of a year for the peak to the bear market in the S&P 500. That's pretty interesting. The global financial crisis took 188 days. That would have been October 10th, 2007 was the market top. So about 6 months later in June of 2008, yeah, it was about that. Hold on just a second. 1987 market crash, which was before my time, took 38 days. And the commie virus took 16 days. It's crazy, man. It's 16 days. And then it went down in 35% in 31 days. It's absurd. All right. Now here's the market drawdowns, and we can see here's the commie virus here, which is that's 1987 crash. Excuse me. That is the epitome of a dead cat bounce right there, my friends. See, it fell like a brick in water. That was one day, man. And then it went up, and then it fell again right there. Look at that. That's a dead cat bounce. Right there is a dead cat bounce. The drop, the dead cat bounce, the drop. Here's a commie virus down 30. This was in March. I don't even think they had. I'm not sure when this was published in March of 2020. So I'm not sure if they even said they had it going all the way down to by the time March 23rd rolled around, which is the bottom. But you can see, look at that. 18 days. Here's a global financial crisis. Started in October 2007 to March 9th, 2009. And here's the dot-com crash. So by September 11th, right here, I bet that's September 11th right there. And then you got remember that was the dead cat bounce right there. The first 3 months, the latter part of the 2002, everyone's like, "Yay, we finally beat it back." And then the first 3 months of 2003, it got crushed. I'll never forget that. We're thinking. I mean, that was tough. That was a long, tough path to deal with. During the global GFC, the global financial crisis, investors were worried about the unraveling of the financial system and the potential for another depression. But never did people worry about their own physical health or that of their families. In fact, you'd be hard-pressed to name a similar period of fear for one's well-being for such a large segment of the global population since at least the Second World War. Well, I should never have been worried about it other than a select group of people, which is what we knew since day one. They kept trying to say, "Oh my goodness, children are dying." It was all fake, man. It was all fake. It's said that generals always fight the last war. In our context, it been said that economists always fight the last recession. But it's said for good reason. All crises, whether they be wars, depressions, or even pandemics, are inherently different from one another. However, people's reaction to them is remarkably consistent. Isn't that right, Pablo? It's kind of like a particle. Wherever I go, he follows me. It's crazy. As the brain assesses a threat, it triggers a fight or flight response. Anxiety rises, logical processing and reasoning diminish. All right, the same behavior applies to sell-offs and run-ups in financial markets. While repricing of assets is likely necessary in light of this crisis, we are almost certainly going to see an overreaction. Well, we did. I think they had written this before it fell all the way down 35%, the S&P 500, if we have not already, and as panic and indiscriminate selling spreads. Let's just take a look on the S&P 500. What did it to drop below I think it did drop below 2,000. Let's see here. No, okay, it's down to 2,100. Drop below 2,200. Okay, that's a low. All right, gotcha. Yeah, never quite fell below 2,000. All right, pretty doggone close. Yeah, 2,200. Pretty doggone close though. Great. And today the market is up another 30. The S&P was up another 38 points. 1.2%. It's insane. Insane. That just is insane. Let's see. This can be seen time and again throughout history as investors react out of fear to the fog of now undoubtedly making mistakes that later seem all too obvious in the clear skies of hindsight. Yeah, hindsight is always 20/20. Here's the 87 crash, and here we came all the way back to 1993. And there's a sell-off, the global recession, or the 1990s. Look how small that was. That was part of what led to Bill Clinton taking down George H.W. Bush. Look at that, though. I mean, so people are freaking out. Oh, my goodness. I just tell you. So here's a crash. Then it fell all the way down to January of 1989. So, I mean, right there is when Bush won. That was when he's inaugurated. And then that little right there. That's what they said is the greatest recession since since the Great Depression. That's what they said. I remember that. And that was the Saddam War and all that with the oil price shocks. And then it just took off like a bat out of hell. This is trailing PE ratios, by the way. So you can see the price to earnings ratio. This isn't actually a stock price, but it's the price relative to the earnings. And so here, the long-term average is about 18. I don't think it's 18. Yeah, they're saying about 19 there. I don't. S&P 500 long-term average is 19, maybe since 1987, I guess. But anyway, so the average is 19. You can see we have way below 19 here in the Great Recession during the market crash. Basically, George Bush all the way up until January of 91, it was below 16, around 15 or so. Didn't hit that again until 2009. Even during the dot-com bubble, the S&P 500 PE ratios stayed above. Look at that. It did. And right there, 2009, fell to 12. 2011, that was I remember that was the latter part of the middle of the year of 2011 right there. From May to August, it fell to about 12, which is pretty good. Then it rose. It got killed here. That was in the first quarter, or the last quarter of 2018, then right there. And that's trailing PE. That's the problem with trailing. That's, again, I did videos on this saying this is what the PE was with earnings that were backwards, and earnings are never backwards looking. Earnings are always forward looking. And that's what happens. They said, well, the earnings that we had before it's irrelevant now because we have all this shutdown and whatnot. Waiting for the all clear signal. News headlines from March 6, 2009 were dominated by one of the worst monthly jobs report in U.S. history, as 744,000 jobs were lost in a single month. March 9th, 2 days later, the U.S. equity market bottomed and began its recovery despite the backdrop of recession raging on. Historically, this is not an isolated event. Over the last 80 years, the market has bottomed on average 170 days before the end of recession. 107 days, excuse me. I love this chart right here. Contribution of capital appreciation and dividend income within the S&P 500. So here's the dividends is a green. Here's the purple is a capital appreciation, just appreciation in the share price relative to earnings. And so you can see right here for the 1940s, 5.5% of the market gain was from dividends. In the 1930s, 4.4% was of the gains was from dividends, but it had negative price earnings or PE ratio, not PE ratios, but capital depreciation. So we lost about 1% annually in the 1930s because we're getting 4.5 on dividends and 5.3 negative loss on capital. Here we had 8.5% annualized, and the bulk of that was from dividends. In the 50s, about a third was from, not a third, about a half was from dividends. The 60s, roughly the same. The 70s, we had hardly any price appreciation, but 4.3% from dividends. The 2000s, because we had a negative decade, 2.7 price depreciation, 1.8% dividends. The 80s and 90s, the bulk was from price appreciation. Same with the first part of well, I guess I should say the teens of 2000. The average is 3.9% from dividends and 6% from price appreciation. That's your 10% right there. 40% from dividends, 6% from price appreciation, which is why you should buy dividend stocks for sure. The risk of missing out, we talk about this a lot. You miss the 30 best days of the market, you're down. Your average return for 20-year annualized rate of return as of March 26th. I guess it was that was the bottom right there, March 23rd. You missed 7.2%. You would have lost 7.2% a year if you missed the bottom 30 days, or the top 30 days. That's, if you stayed in, you would have averaged 10.5%, which means you doubled your money you doubled your money almost 3 times. So from March of 2000 to March of 2020, 100,000, 200,000, 400,000 bucks, right? Yeah, that's about right. If you use this rule of 72. Yeah, or even 800,000 bucks. 1, 2, we got one. I can't. Either way, you would have made a lot of money. You would have doubled your money once. And then you would have doubled again. Right? That's 3 times. Anyway, it'd either be worth 400 or 800,000 off the top of my head, I can't remember. But still, you got 10.05% for 20 years if you just stayed in the market. If you miss the 10 best days, you only average 1.87. There's no better chart in the world than this right here. You have to stay in there. You have to stay in there. I was watching Beat the Bush today. I'm like, you're not long-term investing if you're getting out because the market. He's so worried about the coronavirus. It's just weird to me, man. He's just like infatuated by the risk of it, and it's just not there. It's weird to me. He should know better. Anyway, I love it. I'll put a link in the show notes of this. I'm a huge fan of this chart. Definitely read it again for the love of me, man. If you're going to be in the markets, you got to stay in. You can't get out, get back in. It's just, you can't do that. You've got to stay in the market. Just more proof right here. I'd love to hear your comments. Thanks now.